Hey everyone, welcome to the show. This is my first episode syndicating across Facebook and YouTube, so please forgive any technical difficulties. I hope everybody can see and hear me and technical difficulties have subsided. Let me know if everything is a go on your end, and we'll be getting started very soon here. Today's a different episode. We're doing a Q&A, so I think it's important that we hang out a little, wait till we get some questions in the chat before we begin. So let me know if you can hear me loud and clear over on Facebook, on YouTube. See, we've got 5 viewers on YouTube, so that's a good start. And Facebook, I don't even know how this, oh, there we go. I can see the live on Facebook now. Cool, so please drop your questions into the chat box on either YouTube or Facebook. We're gonna get started in just a minute here. While we're getting ready, let's just go around the horn. I got all the cameras set up today. So of course, we've got our koi cam, which I didn't have enough time to get that really a good angle, but we'll check in on the koi from time to time. We've also got a zoom lens, a huge telephoto. Look at that, that's like super zoomed in on the birds. So we'll see if we see any birds. And then this camera, I'm gonna spin around once we get into the show to have one more potential bird watching camera angle. Okay, so without further ado here, actually one more ado, let me just thank all of the investors who've signed the non-disclosure agreement this past week, just to get us started here on the right note. So let me just check my CRM here, created in the last 7 days. Thank you to 10 investors: Brett, Richard, David, Katrina, Jamila, Mark, Narashima, Keith, Vero, and Corey. Thank you all so much for signing the non-disclosure agreement over at FIXnotes.com/buy. Getting ready for 2021. We're gonna have some awesome opportunities to acquire mortgage notes, probably performing and non-performing mortgage notes next year. So if you have not already signed the non-disclosure agreement, head on over to FIXnotes.com/buy to do so. Okay, we've got 6 viewers over on Facebook, on YouTube. Facebook, I don't even know how this works yet. But I'm not getting any comments yet. So please leave some questions so that we can get into the show. All right, let me get things set up and think of your questions and drop them in the chat, and we will go to the show. All right, everyone. Thank you so much for joining us for yet another episode of Be the Bank. This is episode 27. It's the 16th of December, and we're going to be covering some of the agenda items as normal. Overview of the industry. We're going to talk about pricing. We're going to talk about due diligence. We're at least going to throw up those slides so that some question and answer can be completed on the context of the previous episodes that we've completed. Kevin, thank you so much for the comment. What parts of due diligence do you do before and after your letter of intent? That's an excellent question, and we'll cover that very soon. Please leave some comments if you guys have some other questions as well. We will throw up that tech slide, the software, the services that we use to run our business, so that you can ask some questions surrounding our tech stack. Then, of course, asset acquisition opportunities, just to get you guys ready for 2021. If you have not signed the non-disclosure agreement already, we're going to show you how to do that. Then some case studies. As always, even on a Q&A show, I've prepared 2 case studies for you that we're going to go over together. And then finally, a quick aside with the giveaways and showing you how you can get on a free consultation call with me. Awesome. All right. So this is your first time watching the show, and I think maybe on the Facebook side, we're going to have some new viewers. We have not syndicated to Facebook in the past. So let me give you a quick overview of the offering that we have available to you on FIXnotes.com. It's all free for the most part. FIXnotes.com/learn is our 100% free How to Invest in Mortgage Notes course, which is organized in a way that I think structures your learning experience to get into the note business or to brush up on your skills in a way that's very easy to digest across these different portals: getting started, the market, due diligence, closing the deal, and asset management. A whole bunch of content for you on FIXnotes.com/learn. FIXnotes.com/news, an industry news aggregator using an RSS feed. And actually, This isn't updated. I updated for December. We've got like 70 articles already syndicated for December. Going all the way back to when we started the show in the spring of 2020, a bunch of articles on the industry there. We've got FIXnotes.com/terms, which is a glossary of all of the lingo that you need to understand as a note investor, the distressed debt glossary. If you come across any terms that you're not familiar with in your research, let me know and I can add it to this glossary if you don't find it on there already. And then finally, FIXnotes.com/buy to sign the non-disclosure agreement. And our one and only upsell is FIXnotes.com/MNM. This is the Mortgage Notes Mastermind group. We, first of all, $30 a month will give you 50% off my consulting rates. And also, we've got a whole Podio workspace for you, including the current industry events. We've got a forum where you can communicate with me at no additional charge. We've got case studies where we detail the case studies we run on this show in more detail. We've got a database of all of the counties in the country, along with all of the states in the country and the relevant foreclosure, super lien status details, timelines for REO, expense estimates across every state for REO and foreclosures. Whole bunch of content there for you that I think will be very useful as you start managing a note portfolio. Then we've got inventory, which is a great template on how I organize my mortgage note inventory in this database, and also serves as more content from the case studies. And then finally, document templates, where you can brush up on the letters that we use in this business, and then also reuse these for your own mortgage note portfolio management. Awesome. So that's all of the free stuff we've got for you over at FIXnotes.com, along with the paid upsell for the mastermind group. So let's get into the industry overview. One event I wanted to mention before we get to the Q&A here, and that is the IMN upcoming conference, the non-QM virtual forum, which is taking place at the end of January. And I can change this up like so and go over here. So the non-QM virtual forum is more on the origination side, so non-qualifying mortgage originations, but this could be a good event for some networking opportunities to meet the larger players in the space. So keep your eye on imn.com for opportunities to network and to join these events. This next one on the 21st, they just emailed out the agenda, so it's not super relevant to the mortgage note side of the business, the distressed secondary market, but there could definitely be some networking opportunities and some nuggets of information that would be useful to you as a distressed note investor. All right, so let's get to Kevin's question. We got our first question. What part of due diligence you do before and after your letter of intent, your LOI? So we'll just throw this slide up as our basis for this letter of intent conversation. So the letter of intent is super important because it documents your contingencies moving into the deal. So depending on how much research you want to do before your LOI, that can determine how many contingencies you want to include on that letter of intent that you submit to the seller. So in most cases, I like to get a pretty firm understanding of pricing before I submit the letter of intent. The worst thing you can do in this business is burn bridges with your buyers and your sellers. So if you're looking to purchase a note and you put a pretty strong letter of intent together and then you significantly fade that offer by the time you actually want to buy the loan, you can get into trouble because that seller was expecting a much higher price, and by the time they get through to actually closing the deal, it doesn't look anything like the original deal that was expected. So I would say from the beginning, of course, you got to do secured versus unsecured because that's going to be the largest driver of price. So the first thing I would do is go to protitleiusa.com/order, and I would use their O&E ordering tool to see the estimated property owner on that specific collateral. So once you've confirmed that the property owner matches the borrower's name on your data tape, after that you can move to the next phase of the process. Now, most of the time the seller is going to represent a large amount of data to you on the initial data tape. So you want to trust but verify that information. So most of the time you'll know whether it's a first or second lien, and I would not recommend ordering a title report or a BPO or really spending any money prior to submitting your letter of intent. The point of the letter of intent is to give the buyer some confidence going into the next step of the process that they will basically have the same data, they'd find the same data that the seller has already represented to them. So the value of the property is being represented to you on the data tape. You're confirming that value with the BPO. The lien position, first or second position, the balance of the taxes, some other information would be represented to you on the data tape. You're confirming that with the title report. Those items I would wait to save after the LOI. So before LOI is really all of the free research that you can do, going to the public records to see who's on the assignment of mortgage, to confirm that the seller is actually represented on title as the seller. They're recorded with an assignment of mortgage in the county record. And from there, you want to basically come up with a rough pricing. And you want to be somewhat conservative, of course, on your first offer. You don't want to go too high and get the seller excited about a potential deal that's not going to make sense. So be conservative. And then the goal as a buyer is to make sure that at the end of that due diligence process, all of the data lines up and you're not significantly fading the pricing that you've initially represented to your seller. So Kevin, please drop any follow-up questions as well about the parts of due diligence that you've, I mean, if you have any follow-up questions based on my initial thoughts there. Let me think of some other ideas. Due diligence to do before your LOI. So definitely confirming secured versus unsecured. Confirm that the owner owns, the asset owner has recorded an assignment of mortgage. Check AVM. So you're going to go to Zillow and check recently sold comps. Get comfortable with the property value so that a BPO isn't going to give you a surprise reduced value when you actually start spending money on an asset to do your due diligence. So check Zillow for recently sold comps. If you're buying a reperforming loan, price out the cash flow, run your internal rate of return calculations and your cash on cash return. So IRR, you can use X IRR in Excel and define a date and a payment string. So right off the bat, if you're buying a reperforming loan, it's pretty certain how to price it. You're pricing based on yield. And we'll actually pull that slide up to discuss pricing a little bit more detail, because prior to the LOI, that's the thing you're looking at, pricing. The contingencies around your letter of intent are how you protect yourself as a buyer and basically communicate to the seller what due diligence is still necessary. But pricing, for the most part, if all of the data lines up with what the seller has represented, pricing is not going to change. So you need to understand how to price loans. So while we wait for some additional follow-up questions here, let's just talk about market pricing on the performing and the non-performing side. So as I mentioned, for cash flowing loans, you're always pricing based on that cash flow, based on yield. So when we price based on yield, we see cash on cash returns on the senior lien side of around 7.5% to 12.5%. On the junior lien side, we see yields around 11% up to 20% or more. We've actually sold a number of reperforming loans over the past quarter, and we've seen some yields actually higher than this for larger packages that more look like a fire sale from a seller to a buyer when the yields commanded are a little bit higher. And as you know, on the performing loan side, reduced yields equal higher prices. So even though this looks like a 110 basis point decrease to the yield, that's actually an increase to the price. And this is more looking at retail one-off purchases. This isn't contemplating large bulk sales, portfolio purchases, and you will see stronger yields, greater discounts when you're buying in bulk, when you're buying a package deal. So on the non-performing side, this is really what you're looking at before you submit a letter of intent on a non-performing asset. You want to come up with your pricing on the senior lien side based on a percentage of fair market value, and on the junior lien side as a percentage of unpaid principal balance. So that's why it's so important when you're buying first position liens to look at those recently sold comps to come up with a pretty accurate potential property value so that by the time you make your offer, there's no surprises in that additional due diligence phase. Now, another thing that you can do in addition to Zillow before you submit your LOI is take a look at the Google Street View, because you can get a lot of information from that Google Street View on the current condition of the property. Make sure you look at the lower right-hand corner, somewhere around here, for a date when that Google Street View was obtained. I see in some very rural addresses Google Street Views from like 2016. A lot can happen in 4 or 5 years. So if you confirm that that date in the lower right-hand corner is 2019, 2020, next year, 2021, then you're going to be looking at a much more current picture of the property. Well, that's pretty self-explanatory though, so I'm sure you guys already are using the free resources out there on the internet to analyze loans. But just wanted to mention it in case the Google Street View and Zillow are very, very great tools to do desktop appraisals, desktop underwriting essentially, from anywhere in the world. We're so lucky today to have so many resources available to us through the internet to manage this business in a way that's both efficient and pretty flexible. All right, so I'm looking over on Facebook and I haven't really got any comments over there. So let me try, see if I can like share this page. Yeah, please leave some other comments for this Q&A. I expected to see some more activity on Facebook, so maybe I did something wrong here. That's quite possible. All right, let's see if I can share to, I gotta figure all of that out. Awesome, so we've talked about due diligence completed before and after the letter of intent. The crux of that really is that the letter of intent is giving the seller some assurance as to what happens next, and you're also, as a buyer, being comfortable with exclusivity. So if you are going to be spending money researching title and BPOs and credit reports, you want to make sure that that seller has committed the loan to you before you start spending money on the research. Some investors do start ordering title and BPO before they have a signed LOI in place. That may be part of their process to be more firm on their bids prior to submitting the LOI. If you have deep pockets and a strong bidding process, you could order some paid reports for research prior to your letter of intent. But for most of us, I'd recommend getting that LOI signed before you start spending money on your research. Cool, we got another question from Nick. What is loan acceleration and how does it impact our investments? Great question. So when a loan is charged off by the bank, they often will send a letter of acceleration. And that letter of acceleration is actually documented in your loan, in your mortgage and your note documents, to essentially say that in the event of a default, the full balance is due and payable. So essentially a reinstatement, when a loan is not yet charged off, the reinstatement balance can be just the missed payments to bring the loan back current on the amortization schedule. Whereas a charged off loan that has been accelerated, the reinstatement now equals the full payoff balance. And for the most part, we use that as sort of an initial conversation point with the borrower, and then we'll back off of that. We're not, for the most part, forcing a borrower to pay off the loan in full. We're going to work towards a modification agreement to try to get, if we can, a down payment and then a payment plan, or if not, a modification with just a modification fee. That shows some skin in the game from the borrower. A down payment is very important in that beginning steps to show the borrower, from the borrower's perspective, that they are committed to paying off the loan. So I would highly recommend when buying charged off bank loans to consider the unpaid principal balance, the payoff balance at acquisition. So rather than accruing arrears and potentially retroactively charging those arrears through the time that the loan was charged off, I would recommend pursuing the unpaid principal balance as the most conservative, defensible approach moving forward. Now, once you start sending statements to the borrower and the loan goes from a charge-off loan on a bank balance sheet that's not actively receiving statements and actively being serviced to an active asset on a distressed note investor's portfolio, which is receiving statements and is actively being serviced, then you can start to accrue that interest again. Now, some investors will apply arrears and interest to a loan that maybe was charged off previously. Perhaps if they do not see an acceleration letter, they feel comfortable moving forward with the arrears accumulating. And that's really going to be based on the specific state, your attorney's guidance in that specific state, and your servicer's accounting of the loan. Because at the end of the day, it's going to be the servicer's accounting that borrower is making payments on. Now, I know that FCI lender services is a little bit more strict about how accelerated balances are treated, and then some other servicers like Land Home Financial treat it a little bit differently, but I have heard that Land Home Financial is looking into not allowing the pursuit of accelerated payoff balances, using an accelerated balance as the unpaid principal balance as the payoff amount. And that's subject to change. We'll see how that develops in the near future here, but it's a great question, Nick. Thank you for submitting that. What automation and delegation do you use in due diligence? From Kevin. Great question, Kevin. And this is kind of in line with our conversation from yesterday. Kevin is a member of the mastermind group. We did have a call that focus somewhat on due diligence and how there's a major difference between large-scale due diligence, which I would say maybe 50 or more assets, and small-scale due diligence, which is a handful of loans up to 50 assets. So on the 50-plus asset side, there's a lot more opportunities to use automation and bulk batch services. So for a 50-plus loan portfolio, and we're going to just talk about non-performing second mortgages because that's what I prefer, and I think that's what Kevin prefers as well. In that case, 50 is the minimum viable number of assets to pursue for TransUnion credit reports. TransUnion does not accept batch uploads of batch orders of credit reports if you have less than 50 assets. In the less than 50 asset category, you're going to be needing to manually update all of that loan information to order the credit reports manually. So major difference on small versus large portfolios. But let's talk about the smaller side and some of the automation that's still possible when you're only analyzing one loan at a time. And I'm going to speak to APIs in this context. So APIs are basically how internet services communicate with each other. And you can use APIs for pretty much any web service if you have a competent developer and that API is open and available to be implemented. So I've actually used the APIs for PACER, Public Access to Court Electronic Records, through a third-party provider called Bankruptcy Watch. And I used their API to tap into PACER to automatically pull bankruptcy data based on a borrower's social security number. So that's an automated option to review bankruptcy status, even if you only have one asset. Now, the difficulty there is that Bankruptcy Watch minimum monthly fee amount is $100. It maybe has went up since I, maybe grandfathered into a lower tiered payment plan, but I pay $100 a month for access to this API, which then allows me to run like thousands and thousands of API requests. So I'm actually like way under my threshold for my usage of that API service, but I believe $100 a month is absolutely worth it to have that access. So essentially what I can do is upload just one asset and click a button that says pull bankruptcy data, and we'll automate through the Bankruptcy Watch API to pull the PACER information out. I'll get a date of the bankruptcy, a bankruptcy disposition type, discharge, active, dismissed. I'll get the bankruptcy case number and whether it's Chapter 7, Chapter 13. I've seen some Chapter 11s for some businesses as well. That's a great automation source and a great implementation of that automation because it not only allows us to use it for bulk portfolios, but also for one-off portfolios. So that's a really great tool on the automation side. Here's one that's a little bit more of a gray area that I probably would not recommend using, but Zillow has an API. And Zillow's API is very powerful, very useful, but it comes with some very significant caveats. If you read the Zillow terms of use, the usage of their API needs to be public-facing, and it also needs to come with a Zillow logo. It needs to be fully represented that the data is coming from Zillow, and you cannot save that data onto your system. So Zillow is kind of an interesting case because it could be very useful if you could just scrape all of that data off the web into your database and then analyze the rent comps, the last sold amount, the current rent zestimate amounts, and the zestimate value of the total property. It's definitely a very powerful resource, but to get around it, you need to have that data publicly facing to essentially create like a layer on top of Zillow. And I have thought about this, and I kicked around the idea of using basically like a Zillow for mortgage notes, where you could research a property, get the Zillow data on the same screen as the assignment records and the public information that we have available. So to essentially create a dashboard as an initial phase of your due diligence process. That's a lot of development work and a lot of resources, but definitely an idea that I've considered. And if you guys are interested in something like that, let me know. Along the same lines, using my PACER APIs to review bankruptcy also comes with a very cool monitoring solution. So not only do I use the bankruptcy tool to just pull the current bankruptcy data, but you can also use the bankruptcy tool to regularly monitor your portfolio. So I've considered offering a portfolio monitoring service to maybe the mastermind group to monitor bankruptcies across their portfolio using my APIs. So that's an idea. Another thing, if you guys are interested, let me know. Another question from Kevin. Cool on the APIs. I wrote a simple program with Zapier, Google Sheets, and an email scraper. Yeah, to automatically pull data from the Zillow emails. That's awesome. Google Sheets is a very, very cool tool because you can connect those APIs in a way that's a little bit, it's kind of like you can see under the hood a little bit better. With some services, for Podio, for example, when you look under the hood, it really does look like an engine. And if you don't know what you're looking at, it's pretty difficult to put it together. Google Sheets, similar in some extent, and I definitely think your programming skills, Kevin, are above my pay grade if you've been able to put together a web scraper like that. But I think Google Sheets are cool because it's a little bit more approachable in a way. And Zapier, well, actually, you maybe did it, if you did it with Zapier, you may not have any coding skill, which is pretty amazing. You can use Zapier for like 20 bucks a month to run, I think 20 zaps and like 100 or 20 different, and don't even quote me on that. Look at Zapier's pricing schedule. It may have changed by now. But for the minimum 20 bucks a month or maybe even a free Zapier option, you can do so much online without any coding experience. So Zapier essentially lets you take APIs and other webhooks and apply them to different avenues. So for example, with Google Sheets, you can take Zapier to see a new Google Sheet entry, apply the information from that entry, the property address, etc., plug that in through Zapier's, and I guess it's an API, but through Zapier's workflow, and then push it out to different web services, collect the data, push it back into your Google Sheet, all without using code, which is pretty amazing. All right, so let's take a look over here at the live on Facebook. I don't really see much going on here. We'll have to check at the end of this and see if Facebook even went live. We've got another viewer on YouTube. Thank you so much for joining us today. Please drop a question in the chat box if you have anything you'd like to discuss, either about Mortgage Note specifically, real estate, business, YouTube. Maybe, let me do this. Maybe the instruments behind me. Saxophones are my favorite, as you might have guessed. And I do play these other instruments too. On this side, we've got a guitar, a flute. There's a ukulele over there, a clarinet. It's been kind of a quarantine hobby to pick up a new instrument. Learned mandolin last year and learning flute this year, so it's a lot of fun. Flute's the same fingering as the saxophone, by the way, so it makes it pretty easy. Once you get the embouchure, you can play both instruments. Kevin, what does 2021 look like for FIXnotes? Great question, Kevin, and it's something that I've kind of grappled with this year. Because originally I put a pitch book together for FIXnotes in 2018, or maybe it was in 2017 when I first started the company, that was like very grandiose. Like it was trajectory to, you know, major scale. And the idea was that we would not only have a mortgage note platform for investors to buy and sell mortgage notes, but we would also work with the blockchain to build a mortgage note, you know, decentralized registry. So if you guys are familiar with blockchain and Bitcoin or Ethereum being the most prominent usages of the blockchain, there's actually so much more that's possible using this technology. So I went to a conference in New York City called Corda. R3 is the company, Corda is the decentralized blockchain platform. And I started to learn about it because Corda was actually sponsored by Intel and HSBC and some other big banks. And essentially it was billed as the blockchain for financial organizations and financial transactions. So that was kind of the initial vision, was to build a mortgage note platform on the blockchain so that you'd have basically all of your loan data and your transaction data, your assignment chains, all of the chain of title would all be encapsulated in these blockchain entries throughout this decentralized model, which makes a lot of sense. Honestly, the blockchain is a better place for public records than the actual recorder public records that we use today. But now, since 2017, when I put this pitch book together, which kind of culminated in a very, very cool model of a nonprofit organization that algorithmically identifies certain portfolios and then forgives the debt on the borrowers in the most need. So essentially, the end result of FIXnotes would be to develop a nonprofit, a 501c I didn't do enough research, but develop a nonprofit that essentially buys loans to forgive them based on whether or not the borrowers were in need of being, that debt forgiveness. So we'd create this algorithm that identifies borrowers that are at most risk, single parents, people who have significant medical debt, properties that haven't, maybe properties that are in blighted markets that haven't appreciated in a long time. And then we would take those portfolios, forgive the loans that are identified as in the most need, and then work with discounted settlements and discounted payment plans on the loans that are struggling but in a much better financial situation. So it would be a very, very powerful model because it would not only allow investors who are maybe investing in their own loan portfolios to then donate money to this nonprofit to create write-offs for themselves, but also have an exit strategy for their portfolios. So they could be donating loans essentially with borrowers that really need help. So that's like a huge dream. I would definitely be still interested in pursuing something to that language, to that approach. Yes, a 501c3. Thank you, Scott. And that idea, I think, still lives on in a way, but the effort to get to that trajectory is kind of what I've decided in 2019 and then into 2020 maybe isn't the right path for me. I personally am not a great delegator. I'm not a great, I have one virtual assistant who I've been working with very, very well, but the idea of having a large team and to be keeping people busy, and once you're a boss, you're actually working for your employees. You got to make sure that they have the skills to achieve your goals. You got to make sure that they have the work to complete, like they're not just sitting around twiddling their thumbs. And that was just maybe a little bit too much stress than I'd really be interested in taking on. So 2021 is going to definitely be a pared down version of my initial dreams for FIXnotes. And I think 2021 is going to focus on a couple things. Continuing to automate, continuing to build easier ways for investors and potential note investors to find value in FIXnotes. So that starts with creating a more automated marketplace so that you can review mortgage notes for sale, submit offers, request inquiries and stuff without going through Gmail because my inbox just gets piled and piled up. So the idea, and this is half-baked right now, my developers are almost complete with building out a marketplace that investors can actually submit offers through, and it will go directly into my Podio organization rather than through email, which I then forward to my assistant to add to Podio. Another area where I really need to focus, and I've left a lot of money on the table, is with email marketing, and specifically automation in email to essentially create, what do they even call them? Campaigns with multiple touches. So essentially the first day you join the FIXnotes course, you'd receive an email welcoming you. By the way, if you guys have signed up for the non-disclosure agreement or for the FIXnotes course, I don't really send out any emails until we have mortgage notes available for sale. So a lot of people don't even know that I put this show on every Wednesday, and maybe it would be beneficial to them. So to focus on email marketing next year is a big area as well, to basically provide more content, more education, more value through email to then bring people back into the fold for this show and for the other opportunities that we can work together. Let's see what else. For the most part though, and this was really my main focus a couple episodes ago about a lifestyle business, I do not see FIXnotes being a company that achieves a great scale and takes on investors or even a bunch of employees. I'm building FIXnotes as a business that adds value to investors in the space and adds value to my life as a lifestyle business, not as a overly burdensome stressor on my life that takes some of the joy out of my day-to-day. So that's the goal. There may be some opportunities, and there will certainly be some changes along the way, some audibles that we call to take the next steps in a direction that may be different than what I think it is right now. But for the most part, I have made the decision to not go for broke, go all the way to the greatest scale that I can, and focus more on the lifestyle business side of things. Let's check the cameras while we're waiting here. I got to do this. Oh wow, let me fix that. There we go. It's starting to snow. Let's check our telephoto. Okay, so the telephoto lens is out, and that's black screen. And the koi are like frozen in time. So this is the existence of the koi for the next I don't know, 4 months, they're basically just going to move very, very slow at the bottom of the pond, just waiting for the water to warm up enough so that their digestion works. You actually cannot feed koi during the winter because they can't digest food when the water temperature is below 40 degrees. So, by the way, this camera angle, I tried to like submerge the camera to give us a really good angle, but I didn't have enough time. It was like 12:55, the show starts at 1, and I could only get this far, so it is what it is. But the snow is coming down. It's gonna be a pretty exciting day. I think in the Philadelphia area, we're gonna have some accumulation overnight tonight. But this is not a weather program, so let's get back to mortgage notes here. Thank you for tuning in and for the comments, guys. Nick, Kevin, Scott. Scott hasn't asked a question, but he did correct me. It was called a 501c3, a nonprofit. Let's check over on Facebook. Hey, we got one viewer on Facebook. Please leave a comment if you have any questions at all, any comments too, if you want to just drop a little hello in the chat box. We've got I don't know how long we've been streaming so far, 40 minutes or so. So we're going to get to case studies in just a minute here. If there's any other questions about market pricing or the non-performing waterfall evaluation, please drop them in chat. I hope that so far I've done your questions justice. And we haven't seen any birds yet, so that's a bummer, but the snow is really coming down. Good stuff. While we're just here, let's look at this big real quick, and let me fix my one camera here. Almost there. There's the zoom lens. So we've got this telephoto lens, which it's actually the first show. I figured with Facebook, we got to pull out all the stops. The first show we've been using this zoom lens, and it seems kind of like with the wind, it's not really worth, just going to give you guys a headache. Sorry about that. What is the capital of Madagascar? The capital of Madagascar is Antananarivo. Antananarivo, formerly Tananarivo, the central Madagascar island. Thanks for the question, Scott. Hey, the power of the internet. We can answer any question on this show if you just give me enough time to type it into Google. Is there a mortgage amortization calculator that you or the banks use? Okay, so great question, Scott, and then we'll get to Kevin's about LOI bids being purely mathematical. Also a great question. So as far as a mortgage amortization calculator, I will add one to the FIXnotes Mastermind. Scott and Kevin are both members, so you'll have access to an amortization template in Excel. Essentially, a amortization schedule, since it is purely mathematical, it can be calculated in Excel with just as much accuracy as you'd pay for some proprietary platform that a bank would use. Now, some mortgage companies use products like, what is it called? Mortgage, I don't even know anymore. There are some mortgage note software solutions that do offer amortization tables and that type of information. But generally, I would recommend just using Excel. Now, there's two types of amortization. One would be fixed rate amortizations, which are much more straightforward. That's the template that I'm going to upload into the mastermind group. There's also adjustable rate loan amortizations, which are a little bit more complicated. I actually have a template for that as well, which I will upload. The amortization when it's an adjustable rate loan, though, is going to be based on the Wall Street Journal prime rate. So you actually have to determine the arrears with each period of the changing prime rate. So for example, there'll be, if the prime rate didn't change for the last 4 months, the specific arrears that would have accumulated over those 4 months are different than the arrears that accumulate once the prime rate changes. Yes, Guy, Excel rocks indeed. I will upload those Excel templates to the mastermind group so that you can use the amortization schedule using Excel that I think is the most flexible, the most useful. And that can also be used to see, based on a non-performing loan, at what point in the amortization table they would be at if they caught up on their payments, or how far behind they are if they're looking at your last payment dates and your next due dates. So Kevin's question, can letter of intent bids be purely mathematical? Yes, you definitely want to create a model to systematize your offers. It's important in the beginning to do it manually just so you understand some of the nuance behind it, but eventually you will develop a model which you can plug in to price out a portfolio of loans using a more mathematical approach. Now, just kind of a quick and dirty way to do a model around mortgage notes is basically to create a second tab on your Excel sheet. So you got an Excel sheet. The first tab is the inventory of assets. The second tab is your different asset categories, your different subsets of the portfolio. So to make it really simple, you maybe have first or seconds, and then within firsts, well, let's just talk about seconds. So you're looking at just second non-performing loans. So you could have 3 columns, one for equity, one for senior lien status, and one for bankruptcy status. And then you can create basically permutations, every single permutation of those 3 categories. So let's say the senior's current and it's positive equity, no bankruptcy. All right, that's one asset class. Next one, senior current, it's non-equity, so it's maybe an underwater loan. Bankruptcy is not happening. So next one, senior current, partial equity, no bankruptcy. Next one, senior current, totally underwater, no bankruptcy. Then you move on to senior delinquent equity, senior delinquent, no equity, senior delinquent underwater. So you basically create every single permutation of a specific assets subset and then apply pricing across the board. So for the senior current equity no bankruptcy loans, you might be pricing at the top end at 40 cents or 50% of the unpaid principal balance. And then maybe you dock 2 points off of that if it's, I would dock more than 2 points, but let's say it's partial equity. You decrease by 5%. So those are going to be 45% instead of 50%. For an underwater, you might go down to like 30%. So essentially you define the pricing and the asset class across an entire table. And then on your inventory side, where you're actually analyzing the mortgage note data, you use the same exact verbiage. So if you call it underwater, you call it underwater on the other tab, and you use a VLOOKUP formula to grab the specific asset class on your inventory and append the specific pricing on your model, your pricing matrix. So essentially you can take a portfolio of 1,000 assets that have all been initially analyzed, so you know generally what bucket each loan falls into, and using VLOOKUP, you apply the bucket's percentage of UPB into the inventory sheet. Now that was a little hard to discuss, and I don't have like my model up to show you, but if we get on a call, if you want to set up a consulting call with me, I can show you a rudimentary model that you can use to get started with basically just defining the different subsets of portfolios, defining the pricing per each subset, and then applying that pricing to the dynamic mortgage note portfolio that you have. It's a really great way to do it that way because you've got some adjustable knobs if you want to essentially increase your approach, be a little more aggressive on your pricing. You can just tweak the pricing on the matrix on your model and then apply that new pricing to a mortgage note portfolio, which can give you a very quick and dirty way to analyze a portfolio with some level of dynamic pricing, so you're not just pricing the same across the board. Definitely would love to talk about that on a consulting call. Okay, let's pull these birds up for a little since the snow is just getting started here. This is the one and only place on the internet that you get to hang out with me and watch birds. And we talk about notes sometimes as well. Thank you everyone for joining. We got 8 views on YouTube and we've got 1 view on Facebook. I really got to figure out how to use Facebook Live a little bit better. Okay, so actually let's get on to the next phase of the show here. We're 45 minutes in and I think we can move over to tech tips and then we'll talk about the case studies for this week. Thank you for all the questions, everyone. This is a good amount of feedback from our general, oh wait, over here, sorry. I'm actually gonna switch like this. All right, so as you guys know, we use a lot of different software and web services to make this business work in our favor with efficiency and automation. These are some of the various different web services that we use. Please use this as an opportunity to ask any questions about some of these different things that we implement in our business. Podio is sort of the core of it. If you're a mastermind member, you can start to get familiar with Podio because our mastermind is built on the Podio platform. And Citrix Podio Workflow Automation is essentially the Zapier of Podio. It's actually more powerful than Zapier and has a lot more features but it is a little bit more complicated to use. It can really only be fully utilized if you know JavaScript, which is why I hire developers for this type of work. We've got Zapier, of course. When you don't know how to code exactly, you can use Zapier to tie together these web services. Pacer, public access to court electronic records, we've already mentioned on this call. Right Signature, I also use their API to send out purchase sale agreements and the non-disclosure agreement to investors. Gmail, of course, can't get away from it. DataTree and CoreLogic are important to mention for those due diligence questions that Kevin had earlier. CoreLogic, I would highly recommend for bulk analysis of mortgage note portfolios. CoreLogic's CredCo product particularly is uploaded through an FTP service. So you actually have to log into an FTP server, upload a data tape in a very specific format and a very specific naming convention, and then CoreLogic's team will find that and pump it through their CredCo product, which provides a whole bunch of data. It provides not only the credit report, bankruptcy information, AVMs, but it also provides the last ownership name, the type of ownership transfer. So you can use CoreLogic CredCo's service for about $10 a pop, I think maybe $11 or $12 when you just start a new plan with them, to determine pretty much all of your due diligence initially. Now, it's another one of those trust but verify types of activities, because CoreLogic, since they use technology to automate a lot of this, I always revert back to the original PDF of the credit report when I'm analyzing loans that went through CoreLogic CredCo. We did a CredCo call, like episode 5 or something. We went through CredCo's output file. So definitely check that out when you're ready to scale up and buy larger portfolios. DataTree, on the other hand, is a really great service for one-off research. Provides a lot of the same information that CoreLogic provides, but you can do it one at a time through a dashboard that basically gives you access to public records at the county level, but in a very consistent, like you're looking at the same portal every time, not having to determine how a specific county's portal works. Because if you guys are getting into due diligence, you understand that every single county has a different way that they search records, that they provide the output of those records, the documents that are available in public records. DataTree essentially simplifies it. It'll cost you. You actually will pay DataTree for documents you can get for free if you're not really looking at the county record to begin with. But sometimes that convenience is worth paying for. Then we got ProTitle USA. Already mentioned ProTitle as an excellent service to begin your due diligence process. ProTitleUSA.com/order is a free way to check secured versus unsecured to see the estimated property owner of a collateral address that you plug in. As we've mentioned, Google Sheets, very powerful. Google Sheets, I would say, is more powerful than Excel when you're using services like Zapier and webhooks. Now, well, caveat there. Excel is more powerful than Google Sheets all around if you know how to use macros. I don't like using macros in Excel, partly because they often break on Mac, and maybe they're more robust on PC. But Google Sheets, since it's a web-based service, it looks the same on any platform and is a little bit easier to build automation into Google. Although Excel is always my preferred when I'm running pivot tables, when I'm building my model, when I'm analyzing large data sets. You should get these guys to pay you for sponsoring them. Yeah, all of these guys. Yeah, you're right. I think for the most part, though, this show, I've thought of that before, like the events that we share with you guys, we could use the discount codes and be getting paid for everybody we refer. But at the end of the day, this show is about adding value, not about extracting value. And obviously, we're leaving money on the table in some cases. But at the end of the day, it's really not the biggest deal. But you're right. And when you do get started with these services, there are some difficulties in like your onboarding. For example, with TLO and TransUnion, to get access to credit reports and skip trace data, you need to have a site visit. You need to have a bunch of boxes checked when someone actually comes to inspect your workspace so that you can have access to these different web services. So something like that is difficult to build a sponsorship around, because most people who go through this process might not even be approved for access to this technology. So definitely something to think about, and I appreciate the idea there at the very least. All right, so any questions about any of these software or web services, please drop them. Here's one from Scott. What apps should I start with in Zapier for Podio? Great question, Scott. It really depends on your use case. So for me, one of the first apps that I developed through Zapier was my onboarding of investors. So I used Typeform, which is how you complete the information for my non-disclosure agreement. And Typeform passes through Zapier into Podio. So essentially, I liked Typeform's form tool better than I liked Podio's form tool. So I could go from Podio directly to a web form, and I can show you how to do that, Scott. That's actually available in the free version of Podio. You can create a web form that allows anybody on the internet to go to a URL and upload data that goes right into your Podio workspace. But I like the way Typeform worked. The user experience was a lot better. So I used Typeform and then Zapier to pipe my Typeform data into Podio. So that's kind of like a front-end marketing lead generation potential. I would say if you're just managing a portfolio, you could use Zapier as Kevin did to pull data from Zillow or from other AVMs around the internet. That could be useful. What else could you use Zapier for? If you have an onboarding process to bring in opportunities around, opportunities to buy assets, and you want to pump that data into your Podio, you could create a Google Sheet that pushes data from a seller who can upload their information to a Google Sheet and then push that data into your Podio research area if you had an inventory in Podio where you're analyzing assets for sale. Now that I said that, I'm kind of taking that back because I really like to start my due diligence in Excel. And you really can't fully utilize Podio as a due diligence service until you hire a developer and really build it all out. And I've kind of ran into that problem with Podio because I started building a research workspace in Podio to run all my due diligence. Like I mentioned, the Pacer, bankruptcy, extracting that data, getting Zillow comms, credit data, everything pushed into one place. And what I've found time and time again is that there's always a missing feature that I need to go to Excel for. So even when I upload everything into Podio, I'm just exporting it all again and analyzing it in Excel. So my general practice for large data tape due diligence has been to manage the entire process in Excel until we get to the point where the deal has been approved and we're ready to fund. Once the deal has been accepted by the seller and you're sure that you're buying these loans, that's when I upload it into Podio, because otherwise I'd be exporting back to Excel over and over again for these different pivot tables and analysis that I need to do in Excel that I can't do in Podio. It's possible in Podio, but with a very, very extensive development effort, which frankly, it's above my pay grade and my developers are very busy. So we don't often deploy the solutions that we need to in time. So Scott, I would say to go to Zapier and see the different services that are possible to connect to Zapier and see which ones you're already using. There may be some ways to tie Gmail into Podio using Zapier, which would be very powerful since we can't really get away from Gmail. Otherwise, I really like my API connection between Right Signature and Podio, which can be implemented through Zapier. Ideally, you'd implement the Right Signature connection through Citrix Podio workflow automation. That's actually how mine's set up now. But if I had to build it again, I don't know how to connect it to Podio through Globoflow or Citrix Podio workflow automation. It used to be called Globoflow. So I had to hire my developer for that connection. But I would be able to do it myself through Right Signature into Zapier and then pushing Zapier to Podio, which maybe is a good idea for you if you need to have documents signed. But for the most part, I'm not using Right Signature for borrower-facing documents. I make sure to get a wet ink signature from a borrower for filing a modification agreement, for example. We're only using Right Signature for investor non-disclosure agreements and investor loan purchase sale agreements. But there's many, many different services that Zapier connects with. So go to Zapier.com, see what else they offer. Pretty much any web service now, Zapier's got some pre-baked zaps, they call them, which are different manipulations of the data, pushing it to different web services. So see what you use and then go from there. But at the end of the day, I think a lot of your initial tasks, completing them manually in Podio is going to give you a better feel for Podio, understanding how it works. And then when you're ready to automate and hopefully you've documented your processes, that's where you can identify the all of the top priority Zapier or automation tasks in general that you want to outsource or automate. All right, so let's move on to the next slide here. Unless we've got another comment. We've been on for almost an hour now, so it's just in time. We'll talk about the due diligence, or sorry, the NDA process real quickly, and then we'll get into case studies. All of you on the call probably already know this, but if you go to FIXnotes.com/buy notes or click buy notes on the FIXnotes homepage, you'll come to this page with this big orange button, which is the non-disclosure agreement. This is what I mentioned. This is Typeform, which is a very, very cool like lead generation tool, really, and it has some logic behind it. So basically, like if you say it's a cell phone, it doesn't ask you a follow-up question. If you say it's not a cell phone, it goes to a follow-up question. There's a bunch of tools within Typeform that are very useful that maybe you have an idea to utilize in your own business. Once you sign that form, you complete the document. Once you complete the form, you'll be sent the document, which is the non-disclosure agreement to sign via right signature. You sign that, you'll get it back to you with a membership update. So you now have access. If you go to my account, you'll have access to both the course and inventory. Now, when you click buy notes again, you'll be given a confidential page with all of the unmasked confidential data on our mortgage note portfolio, so you can properly analyze the assets and make some offers. We do not have any loans for sale right now. There will be more product available in 21. So if you are signed on the non-disclosure agreement, you're all set there. When will more assets be for sale? Yes, so in the spring, we should have some more product available for sale, Kevin. I think going into 2021, and this also answers your question about FIXnotes trajectory, I think we're gonna try to start liquidating assets more on a one-off basis so that we can have more investors participate and not just have large portfolios going to large buyers. For example, in this last couple months, we've done a couple big sales that were not available to one-off investors. And that I feel like is somewhat contrary to FIXnotes' mission, which is to more democratize this industry, to allow smaller investors to break in and find their way to build portfolios to generate passive income for themselves and their families. So going into 21, we're hoping to develop a little easier ways for one-off investors to participate rather than just selling larger portfolios. However, we've got a couple case studies, which actually the second case study is an investor sale in one of those larger portfolios. So you can at least use this case study, the second case study, to hone in on that next level once you do reach scale to some extent and you're able to buy larger portfolios, what the pricing's like, what the yields are like. But next spring, I think, mid-quarter, first quarter, I think we'll have some more product available. So you're on the list. If you sign the non-disclosure agreement, you will receive an email when we've got the next inventory tape to release. So you're all set there. Okay, let's get into this case study. So our first case study today is a non-performing second lien secured by a single-family residential property, which was resolved through a modification agreement. Our modification results in a reperforming loan value of $35,000, and we're looking at a property with a fair market value of $190,200, a senior lien balance of $150,095, which leaves us with $40,105 of equity. Now that $40,000 is covering a unpaid principal balance of $56,903. So we would call this partial equity coverage. The combined loan to value, the CLTV, is more than 100% because the senior plus the principal on the junior is greater than the fair market value. From the investor's perspective, though, there is equity here. So you're going to be buying this loan, even as a reperforming loan, for less than the amount of equity. So you're covered. So we look at two calculations here, the combined loan to value, which is the borrower's perspective of equity, and the invested capital to value, the ICLTV, invested capital loan to value, which is the investor's perspective of the equity in the property. So from the investor's perspective, the ICTV is less than 100%, but the combined loan to value from the borrower is higher than 100%, a partial equity deal. So of course we asked three questions. What happened? Where are you now? And what do you want to do? That's how we structure our conversation with the borrower to really get them talking about what they need to move to resolve this debt. So the answers to those questions in this account, on this case, were the borrower's daughter was sick, the medical debts were piling up. That set them back they prioritized, for good reason, treating their daughter's medical issue versus paying their mortgage. And unfortunately, that's a tough decision that some families have to make. And in fact, the co-borrower, the wife in this case, was out of work to take care of the daughter, so they were behind on their income as well. And even though they were living in the subject property, they were behind on the first lien as well. It was originally showing as unknown on the credit when we first purchased the asset, but it was confirmed as current with a servicer statement once we had that conversation, got some more information from the borrower. They let us know they could afford $550 per month to get back on track, and the goal was to refinance the loan in the near future. So what do they want to do? They're going to pay a $250 mod fee, get started with $568 per month on a 15-year term, 8.75% interest rate plan. And this modification started as a non-performing loan worth $12,520, which is 22% about of the unpaid principal balance. And after 2 months, very, very quick turnaround on this one, and $450 of expenses, which covered due diligence, onboarding, collections, and then a modification fee, resulted in a reperforming loan value of $35,000. So you can take a loan as a non-performing investor, fix it up, and flip it to a reperforming investor to make a significant return on your capital here. So a couple takeaways, and then we're going to actually look at the return that this sale generated and the return that the reperforming loan buyer has achieved. The takeaways here are, first of all, senior unknown second liens offer stronger discounts than senior current. If there is any uncertainty at all when buying a loan, that commands a discount. So the seller's goal is always to reduce uncertainty to maximize value. And that's an opportunity for investors who are able to buy larger portfolios. If you can buy loans that don't look like a real gem on the surface, but you can do a little bit more research and find, like, for example, getting the senior lien servicing statement, that the senior is actually current, you add a whole bunch of value right off the bat. So when you're buying loans that are senior current with equity, they're in that top tier bucket, you don't really have any opportunity to go up from there as a non-performing loan. Of course, you can fix it up, it can be a cash flowing asset, and then it's worth more, of course. But things can actually go south as well. The senior lien could stop being paid, the equity position could decrease, and then a non-performing second that you buy in that top tier category might actually be worth less. So when you buy loans that are already starting with some flaw of some kind, in this case it's not a flaw, it's just uncertainty, you could get a better price, which then can give you a stronger return once you finish the deal, once you resolve the loan. Now, no guarantees there, and a lot of times a senior unknown might end up being senior delinquent or a senior foreclosure. So in those cases, it might be worth less than you paid. But to take those risks on a diversified portfolio can actually make a lot of sense. So another takeaway here, request the senior lien statement if the credit report isn't reporting, or even if the credit report is reporting, getting a senior lien statement from the borrower to evidence the payment of their first position lien adds a lot of value to the loan by reducing that uncertainty and giving you confidence as an investor that your equity position is improving. Although this is partial equity now, the senior is being paid down, which is increasing that equity position. So one more here, the rule of thumb for mod amortization is often a payment of around 1% of the UPB. Now this is a failable rule of thumb, as all rules of thumb are. You can't take them for every single situation. But I have found that when you're looking at about 1% of the principal balance, so they owe 56 and we're getting about 560 per month. So that's 1% of the principal balance. That normally amortizes very well. Now, I use that as a rule of thumb only because when a borrower is first documenting with us what their affordability is, how much they can pay, and they could pay maybe $200 a month, that's sort of a difficult conversation right off the bat. To address a $56,000 unpaid principal balance with a $200 per month payment, the amortization is either going to be very, very long or maybe would never amortize properly at such a low payment amount. So in those cases, we've discussed this for previous case studies, we use an interest-only modification, which is basically putting us on the same page as the borrower. As long as they understand that the principal balance is not being paid down, an interest-only plan will keep the loan current as they build some seasoning and some track record to eventually refinance the loan and take advantage of historically low interest rates. By the way, since this is a Q&A call, this is sort of an aside here, but I'm working on a refinance right now for the house that I just bought in this past year. And interest rates right now are 2.375%. And that was before the latest reduction, which I think there was another rate reduction in the last week or two. So for a primary residence, you can get an interest rate of less than 3% today. So that's always a goal of mine, to help our borrowers achieve those low interest rates. Now, it's very difficult when you have a higher or a lower FICO score and your credit is a little shot. But to work with them to move forward to a refinance is best for all parties, because you get a full payoff on your loan as a note investor. They get a much lower interest rate at a fixed rate that they can achieve and afford over time. And everybody gets in a much better position when debt is refinanced based on these low interest rates. So there's an amazing opportunity right now. If you do not own a home, I would highly recommend getting a first-time homeowners incentive plus these low interest rates. It's essentially free money when you account for inflation. So highly recommend either refinancing your current loan if you're paying more than 3 or 4%, and buying a house and getting a mortgage if you do not. Because we are both note investors and borrowers in this time in history. If you're taking advantage of these low interest rates, it's a great opportunity. All right, so the yields on this deal. For the reperforming loan buyer, it's 18.8% cash on cash return. That means that $568 a month annualized is 18.8% per year of $35,000 acquisition. Now, this is a net cash on cash. I've already deducted a $20 servicing fee from this. So $548 per month times 12 is 18.8% of that $35,000 acquisition. So after about 5-6 years, they're going to be in the money and be earning a profit on top of their acquisition here. Now, for the internal rate of return on the non-performing loan buyer, we're looking at a 269% internal rate of return. And I've calculated that out for 8 months. Oops. And the reason we did it for 8 months is because the resolution took 2 months, but we want to hold it for seasoning for 6 months. So if you can do that full turnaround in 8 months, 269% internal rate of return. Okay, so one more case study. This one is a reperforming second loan, single-family residential property that was sold to an investor. So just like that last one was a modification agreement that had been recently completed and maybe will be sold in the next 8 months, this loan was resolved and now has been sold to an investor. So it's the full life cycle of a fix and flip in a non-performing loan. So sale price on this was $11,000. We'll look into the metrics there in a minute. The fair market value of this property was $289,513 minus the senior lien balance of $216,645. That leaves $72,868 of equity, which is fully covering an unpaid principal balance of $21,824. So one calculation that I like to do when I'm analyzing a large portfolio of notes is the equity coverage. So I'll take the equity, positive or negative, divided by the unpaid principal balance and see how much equity is covering the principal. That gives you sort of a margin for error, and if that coverage is more than like 2 or 3x what your principal balance is, then the borrower's got equity, you've got equity. It's a very safe deal in this situation. Guy has a question here or a comment. You can hedge inflation hurting your payments received from note investing by taking a loan mortgage with a fixed rate. Absolutely, yes. You can write off the interest on your mortgage. And I don't know if that's, and I'm not an accountant or a CPA, but I don't know if that's both for investment properties and for your primary residence, but it's absolutely for your primary residence. You can write off the interest. That's what a 1098 at the end of the year is for. A 1098 interest statement, which your servicer will send to your borrowers as a note investor, or you will receive from your servicer as a borrower. That's what you submit to the IRS to write off against your income. So there is no reason not to borrow money right now. If you can get low interest rate, fixed, secured loans, I mean, if you're not doing it, you're going to be kicking yourself later. So definitely try to lever up a little bit if you're confident with the assets that you're secured by, and if you're buying investment properties that the cash flow makes sense. Definitely don't hesitate to take advantage of these historically low interest rates. All right, so let's keep looking at this reperforming second lien sale. So it was a bulk sale. We'll go over some due diligence findings and then the final purchase decision. So this was part of that year-end closeout that I mentioned of legacy inventory, which was really only offered to some larger buyers who have quick due diligence, are proven closers, and could take on larger portfolios. So in this case, the due diligence findings, we found the senior lien was actually 90 days late when it was purchased as a non-performing loan. And now it's rolling late. So it's like 30 to 60 days late on a consistent basis. A rolling late payment on a senior lien you can see on the credit report as a string in the pay string of 2s or 3s or 4s. 1s, so you'll see 12 ones in a row, meaning that for the last 12 payments, the borrower has been current. If you see a string of 2s, they've been late 30 days consistently. They're making their payment, but they're not caught up. 3s would be rolling 60. So in this case, it's slightly behind on the senior, and they are living in the subject property, so it's owner occupied, which is very good news, and they're paying $283 per month. The term was 120 payments, 10 years, 8.75% interest. They did make a $250 modification fee at the mod closing, but they did not make any down payment. And this one was seasoned for 8 months prior to sale. So the final purchase decision here was to pick this loan up as part of the package, not for $67,000. This was for $11,000. That is a mistake. And we'll see the metrics in a minute here, so you can disregard that number. So some other considerations here. So this was a seller fire sale to capitalize on year-end opportunities. That's why the pricing was going to be a lot more attractive than you would see as a one-off investor. A higher cash-on-cash return was achieved due to that spotty senior lien status. So this investor is being paid for the risk. They're making more of a yield because they're taking on more risk. And then finally, 100% internal rate of return for the non-performing loan investor with the fix and flip, because they bought the loan with the senior delinquent. So they're paying like 21% or less of the unpaid principal balance and able to flip this for like 50% or more. In this case, 54.5% of the unpaid principal balance, a 26.5% cash on cash return. That's the sale price of $11,892. So essentially, this buyer is going to make all their money back and then some in 4 years with a $283 payment. So that's very, very strong cash on cash return for a second lien, partly because it was bulk sale, partly because the senior was delinquent or rolling delinquency, and partly because it was a larger, quicker fire sale opportunity. So that's it for the case studies today, everyone. Let's take a quick look at the, let me do this. Take a quick look outside. It's like really snowing now. Thanks for joining me for this fun snow day. All right, so 15-minute consultations. These are available to you for free. My first 15-minute call are always free. Be very, very happy to meet you guys and see how I can help you, point you in the right direction. If you want to get a call beyond the first 15 minutes, I do charge my consulting rates. Please, if you appreciated this channel at all on YouTube, subscribe, like, and comment. If you're on Facebook, share it or something. Really appreciate that, and that'll help you achieve that 15-minute consultation. Or at least we'll start off on the right foot. So you can book me at robbymax.youcanbook.me. That'll give you a calendar of my availability. Schedule a time, and we'll get on a call. And that is it. Thank you so much for watching, everyone. This was a lot of fun doing a Q&A call like this. I'm not sure yet if I'm going to be on for next week. I might take next week off. I might even take the 30th off. I might take the rest of the year off of this show. We'll see. If not, we'll get on more of a casual call like this. We'll watch the birds. We'll watch the fish, if anything was happening. They're so slow, right? And in any case, though, thank you so much for watching, everyone. Quick recap on how you can get in touch with me and achieve or unlock all of this free stuff. FIXnotes.com/learn is our 100% free mortgage note course. Our news aggregator, totally free. You can see the recent happenings in the industry. And then if you're ready to take the next level, join the mastermind group, FIXnotes.com/mortgage note mastermind, MNM. And yeah, sorry, Kevin, in Texas, you don't get snow like this. It's not every day we see a beautiful snowstorm like this. Yeah, thank you, Kevin. Thank you for joining. Thank you for all the comments, everybody. Do appreciate the questions, keeping the conversation going here. We'll try another Q&A. I'll get a little bit better at the Facebook Live. Hopefully push the video out to some more people, get some more interaction next time. And for now, don't hold your breath on next week. We might be taking it off. I know YouTube really appreciates, the YouTube algorithm needs that consistent upload. So if anything, we'll just tune in just to hang out with you guys and watch some birds next week. 2 days before Christmas, and then maybe the same on the 30th. We will see, but in any case, have an awesome week, everyone. I really appreciate it, as always, hanging out with you all, and I love answering questions, love talking shop. So please hit me up on Facebook, LinkedIn, send me an email, or just leave a YouTube comment. I'd be happy to answer your questions there. No snow in Israel either, Guy. Sorry, man. It is fun. You can always tune in and watch the show every Wednesday. Maybe it'll be snowing next week. Who knows? All right. Anything else? Anybody else want to ask a question? I don't want to just cut you off, but I think we've exhausted all the questions for the show today. So thank you so much, everyone. I'm going to just leave you with the snow so we can wrap up the show, just hopefully maybe seeing a woodpecker or something. So I'm just going to switch it like this. And until next time, everyone, have an awesome week. Thank you so much for joining, and enjoy the holidays. Bye, guys.